Hello, my dear future chartered accountants. I hope my voice is audible and PPT is visible. Can you please confirm it, my dear friends? Is my voice audible and PPT is it visible? Okay, very good. Okay, very nice. So, we are doing financial management. We have done with quite a few chapters. Now, let us move into a new chapter called ratio analysis. Why this chapter is important? I'll give you a quick idea. Then we'll go for various types of ratios. Okay, so here it is. So why ratio analysis is important? So just take an example of two companies, company A and company B. Company A provides profit of 1 lakh and company B provides profit of 50,000. So if you look at only profits, company A looks beneficial, right? But if you look at their investment, how much investment they have to do, company A requires investment of 10 lakhs, company B requires investment of only 1 lakh. If I compute a rate of return, how much will be for company A? 1 lakh out of 10 lakh into 100, it is 10%, whereas here 50,000 out of 1 lakh into 100, it becomes 50%. You understand, right? When you look at absolute rupee basis, company A looks better, but when you look at the rate of return, company B better. So when you want to compare, the absolute amount may not be appropriate, a ratio is required, a percentage is required. So this can be applied in various cases also. So in general, how do you know whether you have performed well in exams or not? You need to take, or people will use marks card and will try to analyze. So if you say Reliance is doing well, Infosys is doing well, or some other company, Kingfisher was not doing well, Yes Bank is not doing well, how do you analyze those companies' financial statement? The analysis of financial statements is what here I am calling it as ratio analysis. Hope you are getting what I am trying to tell you, my dear friends. So when you want to analyze financial statements, ratio analysis is one of the key matrices. What analysis? Let's say a banker want to give loan. An investor is coming into the company. A person is starting a business. A merger is happening. So various scenarios we can think of where financial statements analysis is required. And you know people, what is the purpose of preparing balance sheet? You know, people will say to know the financial position as on a particular date, whereas P&L account is to trying to understand what is the results of operations of the company for a particular year. These kind of things are possible in analysis of financial statement. Okay, so first, what is the purpose of or analysis of? You can also write along with me, analysis of financial statement. Analysis of financial statement. So first, what is the objective of this analysis? To compare with years same industry, and to object or to compare with its own previous performance. So comparison happens on two bases. One, you compare yourself with your friend. How are you doing? Are you doing better than him? Are you doing worse than him? TCS company, a software company, then Infosys is also a software company. If you want to understand who is making more profit, who is using the assets better, whose management is better, and who is having more loan, who is having less loan, thereby we can understand which company is better for investment purpose. If you're thinking like a shareholder point of view, right? That is compare with peers. Compare with its own means this year your profitability is 20 crores. Previous year profitability was 10 crores. You doubled your profit. Previous year loan was 50 crores. This year you took loan of 60 crores. You took more loan. So all those kind of analysis, understanding your own growth, comparing with your previous performance is one of the objective. Then components of financial statement. This you know, you are experts. What are the major components of financial statements? Balance sheet as on a particular date, profit and loss account, nothing but income statement, and then we have cash flow statement. These are the main components of financial statements. Then we have the uh, what do you say financial statements users. You know, users are also called as stakeholders. Shareholders want to understand whether company is doing well or not. Government want to understand about various ratio analysis. Maybe bankers want to understand whether they want to lend loan to the company or not, or if a prospective merger, and creditors, employees, all are interested in performance of a company, right? So government is involved. Many people will have the interest in performance of the company in analyzing the various ratios of the company. Now we'll understand various ratios. Okay, till now any questions, any doubts? Hope you are with me on same page so far. The objective of this today's session or this chapter is to understand, analyze the performance of the company, analyze financial position of the company. Are you with me so far? Can you please confirm? Any questions, any doubts? Okay. Now what I'll do, I know we will go to various ratio analysis. Now, but one standard question student always tells me, what is the purpose of balance sheet? Means they will tell you, sir, to know the financial position of the company. Very good. If I show you the balance sheet, now can you tell me their financial position? You will spend 5 minutes. What I'll do, I'll go to a company's balance sheet. I'll show you a company balance sheet, their P&L account. Let's see what analysis you can do. Quick purpose. Can you tell me which company do you want to see? I'll go to that company balance sheet. Any comment, any request from your side? Which company balance sheet you want to see? I'll show you that company balance sheet. Let's see what analysis you can make out of it. Any company balance sheet you want to see? Paytm is not a listed company, it's a private company. Private company balance sheet is difficult to pick it out. We can, but at this point in time, difficult to pick it out. Okay, Sun Pharma Industries, you can look at various companies' balance sheets. I'll do one thing. I will pick it up. I'll tell you how to pick it up. I'll just quickly show you one company balance sheet. So I'll go to company, most popular company, which is Reliance. One second. Just tell me, my dear friends, are you able to see the money control website now? Can you please tell me if you are able to see the money control website? Yes. Okay. Very good. Very good. Okay. So I'll go to Reliance. So various ratios and all will be available, various data is available. I will go to the data point which you can understand. So I will go to financials. Okay. See, I'm showing you the income statement. Can you see income statement? Should I increase the size font or something? Is it visible? Can you read it? Is it visible? Can you please confirm? Are the numbers visible? Yes. Okay. Okay. Very good. Very good. Great. So you have sales. You look at the sales. How much the sales and all? They're having 88,000 crores, 1,36,000 crores, 1,53,000 crores. What is their interest, net profit? See available. If you want, their annual report is available in PDF also. I'll show you the balance sheets. Their position. Look at the share capital. Share capital. Look at the reserves and surplus. Look at the reserves and surplus. 4,46,000 rupees crores. Now, by looking at this balance sheet, can you tell me, is the financial position of the company good or bad? How is the financial position of the company? What do you think? How do you say it is good or how do you say it is bad? Don't tell me, sir, balance sheet is tallying, so very good company. Balance sheet should tally, okay? Only for you in examination, you analyze the balance sheet by tallying the balance sheet. Nobody in the world is going to verify like that. But by looking at the balance sheet, how are you going to diagnose a company? Net worth of a company means what? Share capital plus reserves and surplus. Net share capital is 6339 crores. Reserves and surplus 4,46,000 crores, which means almost 4,50,000 crores is the net worth. They have so many number of shares also. They have contingent liabilities also. You see, so many informations are available. So if you want to analyze, the ratios are given. So we want to understand what and all the gross profit ratio, operating profit ratio, net profit ratio, return on capital employed, return on assets, return on equity, current ratio, quick ratio, leverage ratio, debt to equity, interest coverage, turnover ratios, inventory turnover, asset turnover, valuation ratios, growth ratios, and so on. So, when you look at a company, can you tell me which company is good? What parameters do you think you look at? Can you give me some points? What points, if they are present, a company is good company? What points do you think, if are there, which makes a company good? Contribution is good. Okay, contribution must be good. Meaning, I think what you meant is profitability should be good. Profitability should be good. Goodwill should be there. Okay, you are telling brand is there means company is good. Just because a brand is there, and that does not mean company is good. Kingfisher, you know, it had very good brand. They had good models, but the revenue model was not good. That goodwill also, but their profitability was not good. Goodwill is also important, I agree. Definitely the brand reputations, but all those things ultimately should give you profit, right? So profitability should be good. They should not have too much of debts, because too many debt means risk. They will have to pay more interest. So they should also have more sales. So they should have more. They should be paying their employees on time. They should be paying their creditors on time. They should have sufficient bank balance. They should be utilizing the machineries, utilizing the capital resource. So many aspects comes into picture, right? So when you look at the analysis of the company, what should be good? Like if you want to say some person is healthy, you should sleep well, you should eat well, you should walk well, you should talk well. So when you look at overall, you say that okay, this person is healthy person. Like that. When you look at a company, yes, working capital cycle is also definitely one of the points. So by analyzing all these points, How are you going to say whether company is good or not, whether company is bad or not? Now you should also compare with the peers, right? Maybe sometime later we'll analyze. Hope you got the purpose of this chapter. Purpose of this chapter is to do analysis, compare, analyze, make a judgment. Okay, I'm going back to the PPT now. Can you please tell me, is the PPT visible? The PPT visible now? Yes. Okay. So coming back. So what are the purpose of, or what are the types of ratio analysis we are going to have? Ratio analysis. So what I'm going to do, I'll analyze, or I'll quickly tell you the various types of ratios now. Then we'll go for calculations and numbers. That we'll do it afterwards. So first thing what we look at is called as liquidity ratios, or we'll say short term solvency ratio. Liquidity means short term solvency. What is short term solvency? Whether it is able to meet its short term obligations. For example, you are going to join a company as an employee. Now, when you are going to join a company as employee, every month you want salary. Okay. Now, company should be in a position to pay salary. So, by looking at their balance sheet, by looking at their bank balance, by looking at their debtors, stock, you can understand whether company is in a position to pay salary or not. Whether they pay salary or not is separate. But are they in a position to pay salary? That is called as liquidity, short-term solvency. Then we have capital structure ratios. Capital structure ratios, meaning whether they are having more debt or less debt. What is the mixture of debt and equity? Are they having preferential capital? Are they having obligations towards interest? Those things are called as capital structure theory. So this is also called as leverage. It is mix of debt and equity. Then we have efficiency ratios. Efficiency ratios means this will tell you the operating efficiency of the company, that is utilization of resources. Utilization of resources. You know, having a money is not sufficient. Having a machinery is not sufficient. How well you are using your capital, how well you are using your machines, that is called as efficiency ratio. And then we have last, profitability ratio. Profitability, you know, whether company is making surplus or not, how much profits from operations, the results of company's operation, are they making profits or not? To give you this, okay, you also please write down this chart quickly write down ratio analysis, liquidity ratio, capital structure or leverage ratio, efficiency ratio, profitability ratio. Quickly write down and let me know once it is done. Okay, good. Done. Okay, one more type, one more analysis. How a business works, please understand, my dear friends. How business operates. Okay, can you tell me what is the first step when you start a business? If you want to do a business, what is the first step? What is the first step if you want to do a business? Can you please tell me? The first step in a business is investment, that is capital, promoters, correct? That is, first you should always start with a capital. The capital may be own capital or capital may be borrowed capital, right? It can be any of those two. Now, using the capital, what you are going to do next? Okay, you have money. You have got married, you got money from father-in-law. You have capital. What is the next step? You have cash with you. Will you be like, okay, I have cash, now I can do business? Invest means what? You are going to purchase machineries, you are going to start office, you are going to purchase building, right? So everything you say investment, meaning to purchase fixed asset. Even if you want to do a business like pani puri shop, you need the pani puri vehicle, you need utensils, fixed assets, or you also need money for working capital. If it is a manufacturing company, they need more fixed assets. If it is a service company, they need more working capital. Okay, working capital, that is for day-to-day requirements. One for long term, one is day-to-day requirements. Now, what will happen? What is the next step? Using the money, using the machinery, using the assets, what will you do next? Can you tell me? What is your next step? You produce goods. You produce goods means you sell. You produce, purchase raw materials. You produce goods or you purchase raw materials and then you make a sales. Sales is more important. Just a purchase is not sufficient, just a production is not sufficient. Ultimately it should turn out to be sales, and after sales, as a result of your expenses and your all the incomes, ultimately you get profit. So a business starts from capital, ends with profit. The objective of any business, primary objective, is profit. Okay, so now we are trying to understand what and all is happening from the capital to the profits. From the capital to the profit, this is called as return on investment or return on equity, we can say, whatever it is. Return on investment for a investor, either a own investor or borrowed money. Then the ratio in which you are taking owned and borrowed, that is called as leverage ratios. And how you are converting the fixed assets into sales, this is called as efficiency ratios. And from production to profit, from sales to profit, they are called as profitability. So these are the various stages of business. At every stage, we are going to compute the ratio to analyze. Please write down this chart and let me know if you have any question. So I've given you overview. Now what we do in the next step, we'll take up one ratio by one ratio and we will analyze. That will not take much time. That is easy to remember also. Okay, can you tell me, is it done? And if you have any doubts, let me know. Okay, done. Hope you have taken down, all of you. I'll wait for 10 more seconds. Okay, now let's go to one by one ratios. First, liquidity ratio, or the say short term solvency ratio. Look, liquidity ratio. Liquidity, you know, liquidity means short term ratio. So we have here mainly two ratios. One is current ratio. Current ratio is a current assets by current liabilities. I need not tell you what is current assets, current liabilities. Current assets means anything receivable within 1 year. Current liabilities means anything payable within 1 year. So that is current assets, current liabilities, simple ratio. And higher the ratio, better it is. Higher the ratio, more safety. Because when a person is having higher bank balance, you feel confident, like you feel okay, I can lend this raw material to him, he will pay me on time. So higher the current ratio, higher the safety. And ideal ratio, though we don't have such ideal ratios in practical life, for exam purpose we tell 2 is to 1 is most ideal. Though we don't use it much, just remember it, don't use it much. Current ratio. Then next we have liquid ratio. Liquid ratio means in the current assets, I take out inventory by current liabilities. Why I take out inventory? Because inventory is not liquid. The stock you have to sell it to customer, then you have to convert it to cash, meaning it has two-stage process. It will take some time. Therefore, from the liquidity, if you take out the inventory ratio, what is that ratio is called as liquid ratio, is also called as acid test ratio, is also called as quick ratio. This numerator, current assets minus inventory, nothing but we will take debtors and we will take cash. That is called as quick assets, and that is also called as liquid asset. This also, higher the ratio, better it is. Higher the ratio, more safety. And ideal ratio, they say, is 1 is to 1. Nowhere else we talk about this ideal ratio, only here we talk about it. Anyway, you write it down. Let's go to some problems on this. Hope you have taken it down. Okay. So let me do one thing. I'll do the analysis of all the ratios at one stage. Then we'll go to problems. That's a better approach. The liquid ratio we have done, which is current ratio and liquid ratio. These are the only two ratios, but very, very interesting, important ratio. Okay. Hope it is done. Shall I move further? Good. Okay. Next we had leverage ratio or capital structure ratio. Capital structure. We have equity ratio, we have debt ratio, we have debt to equity ratio. Equity means, what is equity? Net worth. Net worth means we say equity by equity, or we'll say capital employed. Equity by capital employed. We usually multiply it by hundreds. Debt ratio, debt by capital employed, 200. Okay, capital structure ratio, let's write it together. Capital structure ratios. I'll write it. You can also write along with me. Capital structure ratios. Are you able to see the PPT? Some of you telling PPT is not possible. PPT is visible now. Can you please confirm? Sometime internet happens like that. Otherwise, I'll write from beginning once more. Is the PPT visible? I've written capital structure ratio only. Okay. Now, what and all we have here? Here we have equity ratio, we have debt ratio, and we have debt to equity ratio. Equity means how much is invested by own money. The equity ratio is equity divided by capital employed into hundreds. Debt ratio means debt divided by capital employed into 100. Debt to equity means debt divided by equity. No, don't multiply it by 100 here. Debt to equity means just debt to equity, debt by equity. Okay. Now, what is this equity ratio? Let's say if I tell you 80%, that means what? For every 100 rupee invested, 80 rupees is my own money. So this is how much is invested by owner, by shareholder. This is how much is invested out of loan, out of borrowed capital. Debt to equity means what is the loan amount for every 1 rupee own money, for every 1 rupee own funds. That is equity. When I say equity, you know meaning of equity. Equity is nothing but net worth. And capital employed, you know, it is debt plus equity, that is equity, net worth, and debt also. And when we say debt, we usually mean by long-term debt. When we say debt, we usually mean by long-term debt. Equity ratio, higher the better. Debt ratio, lower the better. Because if you take more loan, that means company is more riskier. So equity ratio, higher the better, debt ratio, lower the better from risk perspective. Can you tell me debt to equity ratio is higher the better, lower the better? Debt to equity ratio, higher the better, lower the better? Debt to equity is lower the better, because what is the loan for 1 rupee own funds? Because the more debt to equity means higher is the debt, which is riskier. So higher debt to equity means more risk. So it's lower the better, and debt to equity is most important, my dear friends. Among all the three, debt to equity is most important. Okay, this is capital structure ratio. I hope you are done with this capital structure ratios. Shall I move further? Okay. Now, coming to efficiency ratio. Efficiency ratio. Efficiency means how well a resource is utilized. See, some people will be there. They are like this. They demand lot from their parents. Maybe you also one of them. I want laptop. I want iPad. I want internet. I want mobile. I want books. You want everything, but you don't get marks. There are some people I've seen who don't have anything. They are from a poor family background, but they read well, they do well, they perform well. So, efficiency is not about how many resources you have. Efficiency is about how well you make use of them. A business also, a business says, I want employees, I want machinery, I want this, I want that. Some business keep on telling, I want, but their business will not do well. But some business will do well. I'll give a simple example. You have seen Golgappa fellows? How the Golgappa fellows give you the pani puri. There are some people who will be there. You go and stand nearby him, who is so slow. He will ask you, what do you want? Then you will tell, I want 1 plate pani puri. He will tell, what? Plate pani puri. Okay. He will slowly take his hand, put into the puri, then he will put the pani, then he will give it to you. He does everything in slow motion. Then some people will be there. They are so quick, so fast. Even if 5 people are standing around a Golgappa fellow, he is so fast. By the time you take puri into your mouth, one more round would have come. He is so quick. You understand what is the meaning of efficiency means? Now, I am not telling who is charging more, who is more efficient. I am only talking about activity ratios. The efficiency is also called as activity. So, this is telling how well you are using your resources to convert it to sales, operation. So, efficiency ratios reflects efficiency of management of the company, efficiency of management in utilizing resources into sales, converting the resources into sales. Resources may be capital, resources may be fixed assets, resources may be we say working capital, debtors, whatever it is. How well you are doing things, that is what is efficiency. It does not talk about profitability. Hope you got the point. Efficiency, everything is related to sales. So, we have turnover ratio. Simple formula I will tell you. Observe this. So, ultimately everything is connected to, let us say, capital employed. Capital employed from the asset side, it comprises of two things. One is fixed assets, other is working capital. Now, this is called as sales by fixed assets. This is called as fixed assets turnover ratio. Everything is turnover ratio only. Fixed assets turnover ratio. Fixed assets turnover ratio. And all the efficiency ratio, higher the better. Higher the ratio, higher the efficiency in utilization. Efficiency in utilization. Now, working capital, okay, this is sales by fixed asset. Some people also use cost of sales. Cost of sales by fixed assets. Some people use that also. Now, working capital, we have two elements. For working capital also we have working capital turnover ratio. Working capital, we have working capital turnover ratio. Okay, let me write down that first. Working capital turnover ratio. I hope you are able to remember the formula also, my dear friends, the short forms. For WC, not World Cup, working capital turnover ratio, sales by working capital. The working capital is divided into two parts: current assets, current liabilities. Current assets can be divided into broadly two parts. We say debtors, or we'll say stock. We say debtors, we'll say cash also, but cash is not important. Current liability means payable. So what we have, stock turnover ratio or inventory turnover ratio. Inventory turnover ratio. I'm using short forms. Hope you're able to understand. ITR, inventory turnover ratio. Cost of goods or sales by average stock. Sales by average stock. Or some people also uses cost of goods sold. COGS by average stock. ITR, inventory turnover ratio. Then we have debtors turnover ratio, DTR. Debtors turnover ratio, DTR, is we don't take full sales, we take only credit sales divided by average debtors, average receivable. Now payables means creditors turnover ratio, CTR, creditors turnover ratio, credit purchases divided by average creditors. Credit purchases divided by average creditors. I hope you are able to know the short forms. If you have any doubts in the short forms, let me know. I will solve it for you. ITR, inventory turnover ratio. DTR, debtor turnover ratio. ETR, creditors turnover ratio. Working capital turnover ratio, WCTO. Working capital turnover ratio. Fixed asset turnover ratio, fixed assets TR. Fixed asset turnover ratio. Is it done? Shall I go further? Any questions? Any questions? Let me know. Okay, shall I go further? Please confirm. You're writing, no problem. It's all about how well you are utilizing your resources. It's not about the resources you have, it's about the resources you utilize. You should make use of it. I've seen I've seen people, you have calculator in exam. So many people don't know functions of calculator. They don't know GT, they don't know M plus MRC, they don't know MU. So many people will be there. You don't have idea about the this utilization of resources. That is important. For cash utilization, you can say cash by sales, that is also there, but from exam point of view, it is not used much. For practically, this is also there. For cash utilization, we have sales by cash into 100, cash turnover ratio. We have that cash turnover ratio, cash to sales. But from exam point of view, that is not used much, so I'm not writing it. Practically, we have cash turnover ratio, we have. Fine. I hope I can go further. Next, most important, profitability ratio. Profitability ratio. The profitability ratio can be analyzed from two point of view. For investment point of view, then for operations point of view. For investment means basically from balance sheet point of view. So for equity shareholders, basically owners, what is their investment, what is their return? The formula is their return is profit available, we say EA to ESH, earnings available to equity shareholders. What is earnings available to equity shareholders? Profit after paying preference share dividends. Earnings available to equity shareholders, nothing but PAT minus preference share dividend divided by equity shareholders investment, which is net worth, into 100. Or we can say, if no preference shares, then directly we can say profit after tax divided by net worth into 100. Then we have for capital employed, that is basically from business, for the business. So this will be EBIT. Oh, this is called as, sorry, this is the name I forgot to write down. This is called as ROE, return on equity, ROE. For business, it is called as ROCE, return on capital employed. ROE is for equity shareholders, return on equity. Return on equity, say name itself will tell you, return means profit, equity means net worth, return on equity, profit divided by net worth. Then for business, it is return on capital employed. So we say EBIT, that is operating profit, divided by capital employed. Into 100. This is before tax. If you want after tax, then it will be EBIT into 1 minus T divided by capital employed. Capital employed, you know, debt plus equity into 100. Then from the assets point of view, for assets, we have ROA, return on assets. ROA, return on assets. That is calculated by profit after tax divided by total assets into 100. For operations, that is very simple. We have things like gross profit ratio, operating profit ratio or operating margin ratio. Then we have net profit ratio. GP ratio formula, you know, gross profit by sales into hundreds. Operating margin means EBIT. EBIT divided by sales into hundreds. And net profit ratio, net profit, profit after tax divided by sales to 100. So this is profitability ratio. For equity shareholders, it's called as ROE, return on equity. What is the return for equity shareholders? Whatever is the earnings available to them. That's what I called as EA to ESH, earnings available to equity shareholders. What is EA to ESH? How it's calculated? I think we have done in the basics. EA to ESH, earnings available to equity shareholder, is profit after tax minus preference share dividends divided by equity. that is nothing but net worth. Return on equity, return means earnings, equity means net worth. So earnings by net worth, PAT by net worth. If no preference shares, then preference share dividend will not be there. So you will have only PAT. So PAT divided by net worth into 100. So from an equity shareholder's point of view, he should expect ROE from the business. That is similar to putting the money in fixed deposits. The investor required rate of return from the business is ROE. Equity shareholders rate of return from the business is ROE. ROA consists of both CA and SES, total assets. ROA assets comprises of the fixed assets as well as current assets. Both. ROA is written on total assets. From using the assets, how much profit you are generating. From using equity shareholders' money, how much profit you are generating. For business means from using the debt, how much money you are utilizing. Is it done? Can you please confirm? Shall we go further? Done? Please confirm. Okay. Done. So now we have next capital market ratios. This is used in stock markets. Capital market ratios applies only for listed companies. For private companies, this will not be applicable, only for listed companies. So we have most important ratio is called as price earnings ratio, popularly called as PE ratio. The formula is market price per share divided by earnings per share. MPS means market price per share. Market price per share. That is MPS. EPS you would know, earnings per share. Earnings per share. For example, if you take a company's market price per share is 50, EPS is 10. So what is the meaning of this? 50 divided by 10, meaning P ratio is 5 times. P ratio becomes 5 times. What is the meaning of this? This is important. Listen to it carefully. For denominator means always 1. For every 1 rupee profit, 1 rupee earnings, 1 rupee profit, investors are ready to pay 5 rupees. So if company makes 1 rupee profit, the investors in the stock market, in the share market, capital market, they're ready to pay 5 rupees for it. So higher the ratio, it represents higher the confidence level of investors. Higher the ratio, higher the confidence level of investors. So we cannot say whether good or bad, but definitely less riskier. Higher the ratio, higher the confidence level of investors. This is one of the most important and beautiful formula which is very, very effective yet very simple. Why? See, what is the objective of business? You remember, starting from capital, ending till profits. That is what a shareholders, how much they pay to become a shareholder. That is price, and what they get ultimately profits. So from the investment to the profits, price to the earnings. So the ratio between those two is price earning ratio. For simplicity's sake, you can also remember like this. You know, in a house property income, you get every year or every month rental income. The ratio between rental income and value of the property is called as P ratio. For example, if I tell you 5 times, what is the meaning? If rental income is 1 rupee, value of the house property is 5 rupees. Rental income is 1 rupee, value of the house property is 5 rupees. That is P ratio, one of the very, very important valuation. Hope you got this one. Shall I go further? Any questions, my dear friends? This is very, very important ratio. You come throughout your life, at least till you pass the exams for sure. P ratio, price earning ratio. If I can estimate how much profit the company is going to make, based on that I can estimate the market price. Is it done? Any questions? Okay, I'll go further. Next one, in capital market ratio only, price to book ratio. That is market price per share divided by book value per share. Book value per share is calculated by one second. One second, my dear friends. Just one second. I'll share the screen in a second. Something happened. Just give me 1 minute. Just give me 1 or 2 minutes. This PPT is getting stuck. Okay, is the PPT visible, my dear friends? Now, please tell me, is the PPT visible now? Is the PPT visible now? Is it coming? Whatever I'm writing, please confirm. Yes. Okay. Okay. So we were writing price to book ratio, price to book ratio is calculated by market price per share divided by book value per share. Nice snake, it seems. That's not snake, man. That is my handwriting. Anyway, my handwriting is one of the modern art handwriting. It could be in modern art exhibitions. Anyway, so uh, market value per share is divided by book value per share. So book value per share is given by whatever the net worth of equity shareholders, nothing but share capital plus reserve surplus divided by number of shares. The reason why this price to book ratio is important, because everything what you show in the books may not be the only value of the company. Simple example is goodwill. I don't know whether you are aware or not. As per AS 26, internally generated goodwill cannot be shown in books of accounts. You know that? As per AS 26, internally generated goodwill cannot be shown in books of accounts. So, in your balance sheet, goodwill will not be there in the balance sheet. But as a shareholder, as an investor, I know that company is including the value of goodwill also. So I will pay more than what book value is there. Book value per share only reflects what is shown in the books of accounts as per balance sheet. But market people, market investor sees usually higher value than book value, because they go for actual value of the company, simple difference being goodwill. They pay for goodwill also. They value the company like that. Therefore, book value per share. So, higher the price to book represents higher, again, the confidence level of in. Higher the confidence level of invest, higher the price to book. Okay, so hope you have done this part. Next we have dividend yield. Dividend yield, or some people just call it as yield ratio, dividend yield. This is calculated by dividends per share divided by market price per share into 100, or we say like DPS by MPS into 100. So Mark, see, this is return on investment for a investor, shareholder. Why? Because shareholder, if they want to become a shareholder of a company, if a person want to become shareholder of a company, how does he become shareholder? By purchasing the shares. How much he has to pay? Market price. So for a shareholder, that market price per share is like his investment. What profit he get every year? What profit he get is dividend. So dividend by market price per share is the return on investment in the form of dividends. The form of dividend. EPS by MPS into 100. Okay, hope it is done. One more ratio, I forgot to write it. Let me just give it to you. It's called as coverage ratio. Coverage ratio. First is called as interest coverage ratio. The formula is EBIT divided by interest. If EBIT is 10, interest is 1, that means to pay 1 rupee interest, they have profit of 10 rupees. So higher the ratio, higher the safety, or higher the coverage. Higher the coverage, higher profit you have. Then one more you have preference shares dividends coverage ratio, which is given by profit after tax divided by preference share dividend. Same interpretation, higher the ratio, higher the coverage, higher the safety. Now, interest is paid out of EBIT because after EBIT only interest comes. So EBIT by interest. Now, preference share dividend is after PAT, after net profits. So profit after tax below by preference share dividend. So whatever your income statement was there, in the same structure, you can write this. The same structure, you can write this. Coverage ratio. Coverage ratio. So, okay. Hope you have done till here. Before we go to problem, I would like to discuss one more small point, because I believe that is very important. We should go a little in depth into that, only that aspects. Others we can do it directly, no problem. Okay, next, only for that inventory turnover ratio, I would like to spend 2 more minutes. Inventory turnover ratio and data turnover ratio also I'll spend extra time. Okay, so what was the formula? Inventory turnover ratio is cost of goods sold divided by average stock. Average stock, you know the meaning, opening stock plus closing divided by 2, and cost of goods sold is opening stock plus purchases minus closing stock. Example, if cost of goods sold is 5 lakh, average stock is 1 lakh, and you get the answer as 5 times, which means if 1 rupee is the average stock, you can convert it to sales 5 times of it. So for every 1 rupee stock maintained, company can achieve, 5 rupee worth sales in a year. Or let's just make 6 rupees for example. Just make it as 6 rupees. 6 lakh by 1 lakh, 6 times. For every 1 rupee stock maintained, company can achieve 6 rupee worth sales in a year. 6 rupee worth sales in a year. Okay. Now, can you tell me, if they sell 6 times in a year, how many times they will, how many months once they will sell on an average? Listen to my question carefully. They are selling their goods 6 times in a year. 6 times in a year. So how many times they will sell? 6 times. So how many months once they will sell on an average, can you tell? Once they get the stock, how many months once they will sell? Once they get the stock, how much time it takes to sell? Yes, perfect. 2 months. 2 months. That's called as inventory holding period. Inventory holding period. This is calculated by the 12 months, that is annual period, divided by inventory turnover ratio. In our example, 12 divided by 2 or 12 divided by 6 got 2 months. We got 2 months. So this is the time taken to sell stock. So what is the example here in the given case? The given example, in the given case, once goods are purchased or manufactured, again the ratio depends on amount at which material purchased and market price of the stock. Yes, it is. That's why I'm comparing cost of goods sold. I'm comparing inventory, which is in cost, and cost of goods sold, which is in cost. So both are cost and cost. So we can match it. So it's worth of goods. That's what it means. How much worth of goods? So if goods are purchased, once the goods are purchased, it will take on an average 2 months to sell the good. It may be for after purchase or after manufacture. Inventory holding period. Once it is purchased or once it is manufactured, how much time you take to sell the goods? Have you written till here? Please confirm. Any doubts? Any questions so far? Shall I go further? Please confirm. Done. Okay. Just tell me this now. if inventory turnover ratio is higher, what will happen to inventory holding period? Will be higher or lower? Please tell me. Higher the inventory turnover ratio, what will be the inventory holding period? It will be less, lower. What is the interpretation of this? Interpretation of this. You are having lower holding period. You are selling fast. You understand? Higher turnover ratio, how many times? So inventory turnover ratio is in times. Whereas inventory holding period is in days or in months. Days or in months. Therefore, interpretation is the sales is fast. Sales is fast. Sales is quick. Lower the inventory turnover ratio, higher the inventory holding period days, and that means sales. I can tell you for some students also. Once they purchase study material, they will take so much of time to open their books. That is, their efficiency is low. Anyway, don't worry about that. So higher the inventory turnover ratio, that means lower the holding period. That means you're selling fast. It's coming to the shop, it's going out fast. So its turnover ratio, its movement is faster. And similarly, we have one more formula for debtors turnover ratio. So if you remember, debtors turnover ratio is credit sales divided by average debtors. But one more is there, debtors collection period. Debtors collection period is calculated by 12 months or 365 days divided by debtors turnover ratio. This will give you the recovery period, debtors collection period or recovery period. So higher the debtor turnover ratio, quicker the recovery. Higher the debt collection period, slower the recovery. So when debtor turnover ratio is high, collection period will reduce, turnover ratio will reduce, collection period will increase. Write down this also. Write down this also. Okay, hope you have done. I'll take this part out. Any questions, my dear friends, so far? I'll just give you two important points, two important tips to solve the problem. Then we can go for problems. Any doubts, any questions so far? Okay, just two simple points. So in general, remember these 2 points. All ratios, higher the better. All ratios, higher the better. Only some ratios are there, lower the better. So except, what are the exceptions? Except lower the better are one, debt ratio or debt to equity ratio. Debt to equity, that is debt ratio. Then inventory holding periods and debtors collection period. So these 3 or these 4 elements, I will say, are lower the better. All other ratios, you remember, higher the better. Easy to remember. And second point, comparison should always be within industry, within the same industry or sector. You can't compare a infrastructure company with a software company, with a tiles company, with a service company. So when you are comparing, it should be within the same company. Say Infosys, TCS can be compared. Infosys, Reliance should not be compared in terms of ratios. Do you understand? Because their nature of business is different. For example, a CA marks, a BCom mark should not be compared. I would say a 50% in CA is more than 100% in BCom. You understand? Because sectors are different. It happened to me also one of the times. I should share. My relatives asked me this question. You are a rank holder in CA, is it? Yes. The relative asked, which rank you got? 39th rank. Oh, 39th rank. All over India, 39th rank. Yes, all over India, 39th rank. Then person asked, all over India, 39th rank. Great. How much percentage you got? I told I got 59%. Relatives looked at me and said, 59%. Second class, ah. So their mentality is like that. We can't help. So in regular exams, if somebody asks you how much percentage you scored, you tell 95%. You'll be like 95%. What happened to balance 5%? In CA exams, if somebody tells you I scored 95%, you will be looking at them, tell you scored 95. How many attempts put together you got 95? Or how many subjects put together you got 95? You understand? The standards are different, the sectors are different, they should not be compared. To make it comparable, they should be in the same industry. Okay, anyway, so this is about the basics of ratios, all the concepts required.